Hi, thanks for joining us. Today you have Austin, myself, Brian. We're going to be going over an introduction to private equity recruiting for Forma Futures and walking through a short slide deck, which you can find on the Forma Futures website under the learning section. Brief introduction on myself, and then Austin will go after, is I'm Brian. I currently work at a middle market private equity firm focused on industrials. I previously worked at a smaller private equity firm, also doing industrials and business services. And before that, I was doing investment banking, also covering industrials. And I studied finance in undergrad, and so happy to be here today to walk you through the private equity recruiting process, which I've done once or twice before. Awesome.
Great. Thanks, Brian. Good morning, good afternoon, good evening, everybody. I'm Austin. Like Brian, I work at a middle market infrastructure focused private equity firm right now. Previously, I was at a middle market buyout shop, and then I started my career as a management consultant, doing mostly market studies and operational due diligence for private equity firms. I went to Big Ten school and studied finance and Chinese in school.
Great. If you take a look at the table of contents of what we're going to cover today. So we'll go through an overview of private equity as an industry, and then we'll go over evaluating the opportunity. So more so the process of going through it and how to maybe consider what kinds of private equity firms they are and what considerations you may have. And then lastly, we'll cover as a consultant, banking analyst, or perhaps accountant, what the recruiting and interviewing timeline looks in general. Can vary, of course, but we'll go over how how it has gone on for the past couple of years.
Great. Well, I'll get started with a little overview of the buy side. And I think a lot of folks look at the buy side quite myopically. They think I need to go to banking, and then I need to go to a private equity firm, and I need to go to a mega fund. And that's a great path. That is a platinum plated resume and provides great opportunity for seeing big deals and being well compensated. However, the buy side is a very diverse place with a lot of different investors and investing styles. So if we start on the top left here, you have venture capital. This is often early stage companies, sometimes as early as pre-revenue, where your diligence is focused more on people and ideas. From there, in terms of maturity, we move to growth equity, which is on the top right here. This is either minority stakes, sometimes majority stakes in fast-growing companies, sometimes profitable, sometimes not. And here, your diligence is a mix of understanding people, ideas, and the business and its operations. The third, in terms of maturity, is private equity, which is on the middle left. This is what people typically associate with the buy side. And here, there's definitely part of your underwriting thinking about the management team, whether they're the founders or their outside management. But a lot of times, your diligence is more focused on the business, on financing, on potential value creation that you could do with the business, so operational improvements or changing the strategy of the business. And although this is where people focus on here, there are great opportunities across all of these different buckets. The other three, hedge funds, corporate development, and other opportunities, may be a little harder for Brian and I to speak to because our experience is more in the private equity bucket, but we'll do our best, and hopefully if there's anybody who works in any of those three industries, feel free to leave anything in the comments that you think we missed. So on the hedge fund side, this is kind of the next step in terms of maturity, where a lot of times the company, when private equity um, takes over, they're not really ready for the public markets, at least in middle market private equity. Once they get to public markets, a lot of the hedge funds will do their analysis on how they think the stocks will perform on a quarter to quarter basis, and will take positions leading into those reports, and they'll capture value or lose value each quarter. Um, Some of them are also kind of long only, where they think about stocks that they want to own for the long term that they think will outperform the market, and they will pick those stocks. If you really like stock picking in college, or that's something that you spend a lot of your free time thinking about and working on, might be another option for you to consider if you're an investment banker or a consultant right now and you think that would be an interesting space. The next one is bottom left. It's corporate development. This is kind of a different take on investment banking or private equity. I think it's akin to almost like in-house principal investing. What those used to be big parts of the banks investing off their balance sheet, or if you look at like Macquarie principal investors, where they're investing their own money off their balance sheet into different companies. This one here is interesting because there's a bit of corporate strategy, there's a bit of business unit strategy, and there's an M&A component. And overall, you probably have some better hours in corporate development, but when you're jamming on a deal, all of these have the ups and downs that come with deal related work. And then the last one here is other opportunities, kind of a catch-all bucket. In the list there, they have private credit funds, which have become very popular. I believe Brian's current firm and my previous firm both had um, private credit funds, and that was a large and growing piece of the pie. Real estate investment trust, pension funds. There's real estate private equity. There's a lot of kind of specialized flavors here. The other thing that some of my friends are looking at or have just started in that's not on here that I'd put in other opportunities is family offices, where you're investing the capital of a family or of multiple families, and often you have a broader investment mandate. You could be doing real estate, you could be doing buyout, you could be doing more venture type opportunities, and it's more about convincing the principal or the family member who runs that fund about the merits of your investment, as opposed to closed-ended fund structures like most private equity firms or growth equity firms, where there's a specific type of deal that you're looking for and you just need to go out and find that. So I know that was a lot there. Brian, anything I missed here before I flip to the next one?
No, I don't think so, Austin. Just wanted to echo your point that these are all excellent areas to work within. And although we only put six, if you look at the other opportunities, there's plenty of opportunities within here, even those that we've listed, which are all great, long-term career paths. So that even if they're ones that people typically don't talk about while you're in university or in banking.
Yeah, that's a great point, Brian.
Cool. Now we're gonna go over the overview of private equity, both industry and then also just some of the businesses that work within it. So as you may be aware, at a high level, it's not on the page, but in essence, what a private equity firm does or a buyout shop rather, is they collect capital from various typically institutional investors, which you call LPs or limited partners, and they commit their capital for a period of time. And then the private equity firm with this capital goes about engaging with investment bankers and other deal brokers or private companies in order to um, purchase them with the use of a substantial amount of leverage typically. And then in the meantime, they'll try to grow the business with a variety of organic and inorganic growth levers, which are operational, financial, et cetera, et cetera. And then at the end of their hold period, which is typically 5 years, you've hopefully realized a pretty strong return, both on an IRR and a MOIC basis. And then that the gains from that transaction are distributed to both your investors, the LPs, as well as to the general partner, so the private equity firm, which shares in the profits interest pool, which is called carried interest. And then I guess one other point of note is that the way that private equity firms are funded typically on a day-to-day basis is through something called management fees, which are effectively the fees that they're basically asset management fees that your limited partner slash your investor pays the private equity firm to manage their money. So just the way that a wealth management, like a financial advisor at say Bank of America might charge their client maybe 0.5% or so of your AUM that you hold with them. Similar thing goes on in private equity where LPs provide, the private equity firm with management fees. Um, that's I think the key of it. Austin, I'm sure you might have some other points you'd want to point out as well.
I just had one question for you here. You used an acronym MOIC. For those listening that aren't familiar with MOIC, can you explain what that is?
Good point. Yes. So, uh, MOIC also is used synonymously with multiple of sorry, MOICA is multiple of invested capital. There's a couple of other acronyms that some people use either in Europe or in the US, but effectively, and it's a good question, Austin. It means uh, it's the ratio of your ultimate of the proceeds from your exit over the amount of capital that you invested. So let's say we bought a company for I don't know, $300 million of enterprise value. And then Austin and I, working at a private equity firm, we invested 100 million of equity to finance a transaction, the other 200 being financed by debt. If in a couple of years we sell the business and then the equity proceeds that are distributed to Austin and I's private equity firm is for 100 million, then the multiple of invested capital would be 4.0x. So 4 representing the 400 million in your numerator. We received $400 million when we exited the investment, and Austin and I, for a private equity firm, put in 100 million, and so therefore, our multiple of invested capital is 4.0x, 4.0 times. And the
Mhm.
other acronym IRR stands for internal rate of return, which simply is just if you go into Excel and you put um, in year zero, Austin and I, we invested 100 million. And then in year five, when we exited business, our investment netted us 400 million of equity proceeds. What is the implied return on a percentage basis? Um, Not quite good enough to
Okay.
do the math, but it's above 3 times. Sorry,
Yeah,
it's above 30%. Yeah.
yeah, that's a great example, and I hope we do a 4x deal.
I hope
That's
so. Yes.
solid returns. So the next slide here has a couple examples of firms that fit into these different categories. And here I like how this slide is laid out because I think it gives you more of a representation of how a company will progress between these different stages. A company will typically be family or founder owned in the bottom left hand corner, and if it's a fast growing company, it will go up through these stages: venture, and then growth, and then private equity. The one thing I don't know if this necessarily captures, and it Brian and I spend a lot of our time with companies more like this, which is, let's say they're family owned or founder owned, but they're slower growth companies. They've matured over time and they haven't necessarily taken venture capital money or growth equity money. The founder may be getting old and not have a clear successor in the business or a clear successor in their children, and they're looking to transition their business and their legacy to an institutional owner. A lot of those opportunities go straight to private equity, and there's not actually a venture capital stage or a growth equity stage in between. And then what I would say about these firms here, this is a good representative sample of some of these firms in venture growth and private equity, respectively, but by no means a comprehensive list. There are lots of great firms that aren't on this list. And echoing Brian's point from the first slide, you can really make a great career in each of these, and it depends on the kind of work that you think is interesting and want to be doing, right? If you're interested in venture and you really like meeting interesting people who have bright ideas that are going to change the world and they just need capital to make them reality, venture capital might be a much better fit for you than private equity. If in private equity you really like getting under the hood and understanding how a business works and what is the core creator of value and what can you do to move the needle and how do you break down and analyze how they've done historically and what you can do better in the future, private equity might be a better fit for you. And growth equity kind of sits in between those two styles. So definitely think that these are some great firms to work for. My recommendation is, as you're going through the recruiting process, is not only think about which bucket they sit within, but within private equity, what differentiates an HIG versus an L Catterton. Because when you go talk to them and you go interview with them, you should know that L Catterton is a top top firm in consumer private equity, and they have great relationships with consumer founders, and they've got operating partners that specialize in consumer businesses. Versus HIG, you should know that HIG came from a history of the LBO fund where they were doing 20, 30, 40 small LBOs in a single LBO fund, and they were diversifying risks across a broader portfolio, and they specialized in higher volume of lower middle market transactions, and that's kind of the where HIG cut its teeth before it branched into different strategies. So even within each of these buckets, there's a whole bunch of different flavors of private equity or growth equity or venture capital. And as you start going through the recruiting process, you need to think about not only which bucket do I want to be in, but who do I think is most interesting within each bucket. Anything else, Brian, that I missed or that you want to add here?
Yeah, I think I just want to echo Austin's point about how within each bucket there's a lot of firms that are of high quality that are not necessarily listed on the page, and it that comment goes beyond saying that every firm has merit, and it's not just the quote unquote top funds that do well within the private equity industry, but it goes further beyond that into maybe sector coverage, like Austin was talking about with Al Catterton, or maybe size of deal, as Austin mentioned about HIG. There's a lot of nuance within private equity, and the 12 or so uh, firms that are listed on the top right in private equity happen to be some of the larger and more recognizable funds or firms, but it does not necessarily mean that there aren't private equity firms on in the industry that could give these guys a run for their money. A lot of funds actually, let's say a lower middle market specialist in, you know, aerospace or government services or some niche within business services could actually end up having funds that outperform all 12 of these firms on the list in the top right under private equity, but you just might not know of them because maybe they only hire one associate every couple of years, and so therefore you um, haven't really bumped into anyone who works there, or you don't cover aerospace and you don't cover business services. And some of these businesses, some of these PE firms on the top right are generalist in nature, or just have tremendous deal volume, or have very large funds, and so they're just more recognizable. So as you go about your own private equity recruiting process, you're likely to come across many funds that you just haven't heard of, but could be of extremely high quality.
Yeah, and that's a great learning opportunity to figure out those funds that you don't know about but are actually a great fit. And I think that's a good transition, Brian. You want to talk a little bit about why private equity and why it's attractive to some people?
Yes, certainly. I think there's a lot of benefits working private equity. Many of are generally understood by the banking analyst and consultant community, hence the general fever rush to gold rush to try to get in. But there's some good ones on this page, but maybe just from my end, and Austin can add his thoughts too. For me, what's most interesting is that private equity is relative to banking, because I came from banking, is that it's intellectually a little bit more honest and a little bit more interesting, since the transition is from getting paid to consummate and facilitate transactions to and getting paid when a deal is closed. Shifts sort of to, getting paid to do good deals and create value during your 5 or so year hold period. And creating value is inherently a pretty interesting and open-ended subject matter without any clear answers. So every day while you're managing your portfolio or you're going through the underwriting process for a new deal, you have to make sure that you're being intellectually honest, because you're managing the capital of your LPs, and many of which are pension funds, or to some extent your own money. And so with that, you're sort of in control of your own destiny. And when it's your own money that you're managing, I think just inherently people just by their nature just think differently. And I find that a little bit more interesting than working on facilitating transactions for other people or other businesses. Uh, and then, along that, I think on a day-to-day basis, you get some exposure to the operations of a business. You learn how to be involved with managing one and create value, which I again think is very interesting. Um, and then just your ability to have a more predictable life, I think is quite nice too. In banking, everyone's your client, or everyone's your boss, and that can be a little bit stressful at times. And you have a little bit less visibility into whether a random email will come in at Friday night or so and destroy your weekend. When I think in private equity, being that it's your capital or it's your portfolio company that you're managing, you obviously have to answer to people still, but I think it's just a smaller group of people or types of people that are doing so. And then lastly, I would just say in private equity, I feel like I have more control over my future because it's you're directly involved in the underwriting process and the value creation process, and then therefore, at the end, the sale process. And that gives me more comfort as opposed to um, being at the whim of being the advisor of a private equity fund that may or may not decide to undergo the transaction that they engaged you for. Austin, do you want to talk about your views, especially your views coming into PE, coming from a consulting background?
Yeah, yeah, I can take this bottom right corner here. So when I was in consulting, like I said in the introduction, I did mostly operational and commercial due diligence for private equity transactions. And it was really interesting work, but it felt like I only got to see one part of the transaction. The market part, I think, is one of the most interesting parts about the deal, and so getting to do that, getting to own that piece of work and then present it to the private equity fund or our client in this case was interesting and engaging, very mentally stimulating. And one of the things that I really liked about it is you got to switch between industries and companies and get to learn about each of them in depth. So I think some of those things transferred to private equity that I liked. I mean, for example, right now I'm looking at multiple companies in multiple industries in multiple geographies, and I feel like I get to continue to learn at my job. I think as Brian and I get more senior, we'll have to specialize and have a major. That doesn't mean that we're not going to still have opportunities to learn about other companies and other industries, but there will be some degree of specialization that will occur. But I think it's still very mentally stimulating and diverse in the types of opportunities and industries that you're learning about. One thing that I thought was far superior in private equity is you get to be at the center of the chaos. Like when a deal's really running and you need to ingest all the information from the lawyers and the consultants and the accountants and your buy side banker and the signals from the sell side banker, and you're negotiating with the management team and with the seller, like all of those inputs together, you need to boil down into, do we want to own this business? If so, what are we willing to pay and under what terms and conditions would we do the deal? And just being able to take all this diverse input and get to a clear story of why you should or shouldn't do this deal, and if you should, under what circumstances, I thought has been super, super interesting. So I've enjoyed the transition from consulting to private equity. One thing that I would say that when I chat with people who ask about private equity recruiting, I often get the question, do you think consultants are at a disadvantage? Do you think that it's tougher to get in from consulting? And my answer is yes and no. I know that's such a consultant answer or such a lawyer answer, but I think it is tougher to get into private equity because headhunters are generally more focused on recruiting bankers, and there are certain firms that will only hire investment bankers and they won't hire consultants. However, I think if you can get into private equity as a consultant, your skill set is useful, it is valuable. And neither investment bankers nor consultants are actually doing private equity work in their role as an investment banker or consultant. So both of them have to learn different parts of the process. They have to learn new things. And so coming from consulting, it's not that you're coming with the wrong skill set or an insufficient skill set. You're just coming with a different set of skills, and you need to supplement them on process and modeling and financial structuring and stuff like that, while the investment banker may need to come and learn more about breaking down businesses and breaking down industries, but they've already got good chops on, modeling and financing and stuff like that.
Well said.
This we touched on a little earlier, key considerations of PE firms. I put these in the list of how you differentiate between the firms in a bucket. So like Brian and I were talking about in within that private equity bucket, there were 12 names, but there are hundreds, if not thousands, of private equity firms. So how do you figure out which one's for you? And I'll be honest, it's a tough process to figure out which one's for you. And there's a good chance that the first private equity firm you work at will not be the one you ultimately stay at. Whether you're pushed out via two and out, or you go to business school in between at your choice, or you switch private equity firms to optimize for things you figured out that you liked or you didn't like. However, the better and more informed decision you can make the first time, the higher the likelihood is that you find a good place to stay. And generally, it's better for career development if you're able to stay more than 2 or 3 years. It's going to help you get promoted faster. It's going to help with your economics personally. It's going to help you just be quicker at your job because you know who to call in the finance department to set up a funds flow, and you know who your go-to lawyers are and your go-to consultants, and you know if you need to get support for this deal at IC, you need to talk to this partner and give them a pre-read 2 weeks before and feed all their comments through. Otherwise, they're going to be a stumbling block at committee. There's a lot of efficiency that you can gain by staying in place. So here, they laid out 6 components. Again, this is a good reflective list, but not a comprehensive list of some of the things that you should be thinking about as to whether or not this firm is for you. I'll just tick through these in order, top to bottom. The first one, career opportunities. This one is probably well worth a LinkedIn search. See how long the people have been at the firm, how many of the senior associates came from the associate class, how many of the VPs came from associate. On LinkedIn, you can also do a search where you can see, you can filter by where people used to work and take a look at, okay, well, all the associates that worked at Fund X, wow, none of the associates still work at Fund X. They all work at other private equity firms, or a lot of them left the industry. That's very telling, just as it is if all of their VPs and principals started as associates. The second, salary and bonus. This, I'm going to take an unpopular opinion here and say that salary and bonus should not be your most important consideration. Uh, Generally, you don't get rich in your 20s in private equity, and you get rich on paper well before you get rich in real life into your 30s and 40s. So if you try to think about optimizing now to make an extra 10 grand, that's great, but are you sacrificing other things on this list or the other criteria that matter to you so that you can make an extra 10 grand when you're 24? That's probably not a worthwhile trade-off. And you'll probably make more in the long run if you can go to a private equity firm that you really like with people that you like that has good trajectory on fundraising and returns. Actually, you'll probably, the biggest determinant of your personal economics is probably the fund's performance and fundraising momentum. And that kind of ties into number three here, recent performance. This is very important for me when I look at firms. Brian, I'd be interested to get your take here. Um, Looking at their last fund and how that stacked up versus their fund they raised before that, the time it took them to deploy the amount they raised, if they raised from CalPERS or one of the other public pension funds, and you can go see their returns. How did their returns shake out? And have they gained or lost any partners in the interim is also a great barometer where you can see, oh, wow, they did so well in their last fund, they raised 70% more and they hired a new partner who's going to cover a new industry for them. Like those are all really positive uh, criteria that that give you a feel for the momentum and velocity of the firm. Brian, how do you think about kind of salary and bonus versus fund performance? Like when you're making the decision for yourself, like especially when you changed private equity from firms from the first one you worked at to the second one, how did these stack up or matter for you?
Yeah, absolutely. I had a very stringent way of going about things, and a key principle is I'll take whoever gives me an offer. Is I'm just kidding. The joke.
No, no, no.
Um,
That's a good approach. Like
no, no.
that's
I
how
mean,
it is sometimes, you know.
yeah, that was the first go around to break into private equity. You could scratch all six of these from my key considerations list. It was solely I'll interview in all of the U.S. and whoever gives me an offer, I will go move to wherever that location is, and I will go work for them.
Yeah, you and me
Which is
both.
fun for the yeah, exactly. Which was Austin and I both went to, you could call them maybe tier two, or for me perhaps even tier three geographies, to just to get PE on my resume. But the second go around was a little bit different, um, where I already had some private equity experience, kind of understood how the sort of the game is played, and then had the benefit of being a little bit more curated in my approach towards decision making. But even then, in my second go around, I completely agree with Austin, and on the salary and bonus point, where my 20s, I'm not so concerned with you know W-9 type of income for a couple of years, right? I'm worried more about my ability to get the right experience or survive at the shop I join, such that when I'm 40 years old or something like that, I'll still be in private equity with meaningful, carried interest economics. That's my goal. And so if you're solving for what's going to go on at age 40 and maximizing your sort of NPV, it's probably not how much does this associate program pay versus that associate program. And you always hear these fun things about your buddy's roommate at X PE fund got paid X amount of Y amount of money, and you think about that and you suddenly feel a little bit crappy about your current role. But I generally ignore all of that because I'm not so concerned about that, because in part, I mean, I don't. There's always so much that goes on behind the scenes, or there's so many considerations. As Austin talking about, six of them are on this list, right? That you really can't just use any one data point to form a view of whether someone has a better position than you. Not that you have to compare yourself to other people all the time, but one quick way to sort of illustrate my point is, let's say your buddy's out here making a bajillion dollars at private equity fund A. But the thing is, they might be at a two and out program where in 2 years they're going to have to go fend for themselves and try to find a new job. And maybe it'll be easy for them, maybe it won't be. But for me, I think it's such a competitive industry that's kind of returns are compressing and firms are consolidating, that I value job security more than immediate cash comp that in New York City is taxed marginally at what, 45%. So I would rather go join somewhere where maybe I have a 70% chance of getting promoted to senior associate and then VP and then senior VP. Um, I'll take that over guaranteed cash comp over a 2-year associate program. So I completely agree with where Austin is coming from, but everyone thinks about things differently. Maybe you only want to do 2 years, and then you want to move on to a hedge fund or get your MBA. In which case, maybe it does make more sense to try to maximize your cash comp so that you can go then fund your MBA.
Hmm.
So that's and then on the point about the recent fund performance, yeah, it's tough. I totally agree with Austin that that's the CalPERS websites, all these public pension fund websites are great, great ways to suss out how the fund is performing. But I agree with Austin. Like, if you're looking for the thing that determines sort of your long-term trajectory at one given fund, at least, is definitely something more macro, as opposed to your individual performance. It's more macro. It's are the fund sizes growing and are returns holding consistent or growing over time? If the funds are shrinking and MDs are leaving, then even if you're outperforming and you're the best associate ever, then it just might not be a spot for you. And I would almost rather be a mediocre associate at a at a shop that's doubling its fund size every go around, rather than the top associate at a fund that's sort of like unraveling, if you will.
Yeah, that's a fair point. And one thing I would couch this whole conversation about compensation is the pay in private equity is fantastic, right? Like your bonus, even in the 15th percent or 25th percentile, is probably going to be two times the median American household income. So, you know, private equity is well compensated regardless. And I think Brian's point about comparing to your friend's roommate who works at private equity fund A who made 450 as a second year associate, like all of these numbers are allow you to live comfortably in any city in the world and save for retirement and have a fantastic lifestyle. So I would couch all of these in the fact that private equity is well compensated regardless of whether you're at the 75th percentile or the 25th percentile.
Certainly.
I'll take through the last two or the last three here: lifestyle, attrition, and geography. Um, Lifestyle, I think, is important, but only up to a point. I generally think your 20s are your time to cut your teeth and go to the place where you can have great opportunity, and sometimes that's going to come with rough hours. And regardless of where you go, if you're running hard on a deal, your hours are not going to be good, even at the best lifestyle shop. So lifestyle, I would consider only up to the fact where it's sustainable. So if you go in, you interview for your super day, and the VP and the senior associate who interview you look like they haven't slept in a week, probably not a great sign. If you can talk to people about what they did over the weekend, and the answer is something other than I banged out slides for Monday IC, probably a good sign, net net. But I wouldn't necessarily over-index on this, knowing that your hours are going to come and go, and your 20s is probably when you should be putting in the hours. Attrition, we talked about. I kind of couple that with recent performance, and then geography. This is an interesting one. Brian brought up the point that both he and I um, were more interested in going to private equity than we were going to a specific geography. And we made the decision to go somewhere that is not a tier one market. And when I say tier one market, I mean New York, Boston, Chicago, LA, San Francisco ish. Um, I think that there are a lot of great firms in other markets. I mean, for example, if you look at Rourke in Atlanta, right? Rourke is doing huge deals. They have good momentum in fundraising. They have historically had strong returns, and they're in Atlanta. So that's an attraction to some people. Like if you're from the Southeast or if you're from Atlanta, Rourke could be a great option for you. If you're an investment banker in New York and you're in the consumer group at Evercore and you're looking at exit opportunities, I wouldn't necessarily restrict yourself to New York, because an opportunity to go work at Rourke in Atlanta would actually probably be a great career move for you, even though it's not in New York City. So the geography piece, that's a bit personal and that's a bit career, and it really depends on what you're optimizing for.
Totally agree. And there's also an interesting point on the geography point. I don't know, Austin, if you felt this way, but part of the reason why I cast a wider net was to sort of arbitrage the personal component of lists, where if you know there's some geographies that maybe my peers in New York in the investment banking analyst scene aren't so interested in going. And if I'm willing to go, if they're not applying to those places, maybe I have a better shot at getting a job at that private equity fund. And then ultimately, people care more about experience, deals that I did, than the location I did those deals in, at the office, I mean. Uh, and so that was in part why I cast a broader net.
Yeah, yeah, great point. Okay, you want to switch gears, Brian, and switch to recruiting?
Yeah, sure. So for key steps for successful recruiting, I'd say that there's probably break this down into two sections. The first are highlighted 1 through 6. This is, component one is you have to learn how recruiting works in real life in actuality, rather than how you think it works based on what your friends say or what you read on Wall Street Oasis, and you use this information to form your plan, your individual plan of how to break in, and that's where PFF is excellent in supporting you in, because we have a large mentor base with a lot of people who've worked in private equity who have done private equity recruiting both as an analyst and as a sorry both as an analyst trying to break in and then also as a associate, senior associate, or VP interviewing banking analyst. So, the mentors here have a very solid view of how things work in real life, which is extremely important because the more time you allocate towards things that don't matter, your opportunity cost is pretty significant. And then the second component is 7 through 10. This is more on you. This is more about becoming an attractive candidate with the right experience that a private equity candidate wants to hire. So, PFF can help you with that as well, more in the sense of helping you understand what PE firms like, the archetype of a good candidate. And then, you can in your daily life make decisions that sort of lead you to becoming that candidate. So maybe joining the right group in banking, joining the right firm, or making the right relationships while you're doing banking, stuff like that. So yeah, Austin, anything to add?
The one thing I would add to this list is raise your hand for opportunities that are going to help prepare you for private equity recruiting.
Mm.
So if there's a high probability deal that's about to kick off, go raise your hand for it. If there's an opportunity to help on something that you think will become an opportunity for you to get involved on a deal that you think is going to get done, even if it's kind of a couple steps away, like go for it. Same thing in consulting, right? Network your way into the transactions group or the strategy group, which are the two groups that are going to give you the best, most relevant experience for private equity, and be proactive about getting the right experience. This is definitely how it was in consulting, and I don't know if it was the same in banking, but in consulting, if you weren't active about your staffing, you would just get staffed with whatever is left, which is not the kind of project you want to be working on.
So true.
Yeah, so be thoughtful about what you think you should be working on and what kind of deals and experience you want to go into recruiting with. And then we'll skip here to the kind of how the recruiting cycle works. And I'll caveat this with both Brian and I did off-cycle recruiting. So we'll talk quickly through on-cycle recruiting, and then it might be worthwhile for Brian and I to both tell you quickly about kind of how our recruiting cycles worked off-cycle. So you'll start banking in the summer or the early fall, and the headhunting process will work pretty quickly. If headhunters aren't reaching out to you, it might also be an opportunity for you to reach out to them, depending on what bank you're at or what consulting firm you're at. They may not reach out to you. If you're doing on cycle, you'll probably be in the basket that they're reaching out to you. Number two here, the second number two, I don't know why there's two number twos. Headhunter initial conversations. Treat these as interviews. The headhunters are the gatekeepers. And if they don't think you're placeable because you're not personable or you're not read up on your deals or you're, whatever issue they have, they're just not going to put you in the pile of resumes to send to people. So the headhunters are interviewers, and you should treat them as such. After that, firm networking events and then on-cycle interviews. This whole process is going to move really, really quickly. The on-cycle interviews, some of them only last a few days or upwards of a week from first interview to offer. And then one piece of advice I would give here is you often do not have the opportunity to lever up one offer versus another. If you have something, if you have an offer, you will likely get pushed to either accept it on the phone or accept it within a very short time period. That's going to limit your ability to use it as leverage versus another firm. So think about that as you're either staging interviews or thinking about the order in which you want to stage the firms. To the extent you can have maybe one or two warm ups, but then go to the firms in descending order of priority for you, where if you get an offer, you know you would accept it. that would be a good approach to the extent you have control over the process. Anything you want to add here, Brian? Or maybe do you want to share kind of how your off cycle process worked?
Uh, yeah, I think you made a really good point about taking it seriously. I think some people uh, think headhunters are more administrative professionals, or something of that sort. But in any event, whatever they are, they control your ability to interview at most private equity firms. So you should take it pretty seriously. For me, I mean,
Hmm.
there's always the concept of, who does the headhunter work for, right? Do they work for you to help you get an opportunity, or are they working for the PE firm to help them, find qualified candidates? And the answer is you're not paying them, the PE firm is, so therefore they're the buyer. The PE firm is the buyer, and you're the product.
Yep.
And
Yep.
so you always want to dress up your product, right? And so if I go to a headhunter interview, and on the next page we'll go over how there's only really 10 of them or so that control maybe 80% of the opportunities in the New York or in the US. I will wear my suit and tie because it's an interview, and this person will perhaps even whimsically dictate whether or not I get to interview with the private equity firm of my dreams. And so I'll wear a suit and tie. But then interestingly, like sometimes I go to these these headhunter offices, and I think other people are coming out and doing the same thing, and they seem to not be treating it like an interview. They're dressed a lot more casually. They seem a lot more relaxed, and maybe aren't taking it so seriously. And I don't know how much that impacts things, but I imagine it does. I definitely imagine it does because there's so much discretion that these headhunters have, and they have so little information to go off of. Right, every candidate seems pretty similar backgrounds, similar universities, and similar banks and deal experience, and it's really hard for them to suss out who to go through with. So even very small things, the margin of error and differentiation and stratification is so small that every small thing counts in my opinion. As for my off cycle processes, I think for me probably hard enough for me to get a single offer in general, so not so many opportunities to leverage one offer against the other. But interestingly enough, I sort of played this game of using like competitive tension across different processes to try to convince one firm to give me an offer. And then once I got that firm's offer, which typically might be maybe the one I'm not as interested in relative to the other ones, I'll slowly piece together a way to sort of convince firm two to give me one, and then maybe I'll think of signing with them, and then I'll tell firm three that I'm signing with firm two, and then firm three gives you an offer. There's a whole game to be played there. I don't think it's worth spending too much time on, but if you're so lucky as to be engaging in a bunch of processes all at the same time, you can probably use competitive tension and tools like this to be able to maybe skip parts of interviews with certain private equity firms, or accelerate your process with other ones to get the one that you want ultimately.
Hmm. I totally agree with the competitive tension piece, and that's definitely something I've done. Not to push for an offer, but to dislodge an otherwise stuck process.
Mm.
You call the HR person at the firm or the VP, hey, I have a super day with so and so next week, and I really, really want to come work with you guys, but I can't let a bird in the hand go. And then that provides the opportunity for them to say, okay, we'll have you do the model test tomorrow. I'll send it to you at X time. Bang out the model test. You do well. We'll have you in next week before you go talk to that firm. I think a lot of private equity firms have a feeling that they don't want to lose a good person, which is fair, right? Private equity is really built on talent. You're selling investment discretion and decision making. So finding right people is really important, and being able to almost like investment bankers think about creating competitive tension on buying an asset or buying a business. You can create competitive tension around your own candidacy. Okay, cool. Um, I know we touched on this a little bit, but Brian, I thought you had some really good takes on headhunters. Anything else you want to add here?
Uh, not too much besides maybe just that, unlike in banking where you spend a lot of time networking with professionals at the bank, I don't think that's as much of a thing in private equity because as we were saying, there's hundreds of these private equity funds out there, and not all of them hire every year, and they outsource their hiring oftentimes to headhunters. And so I don't know if there's too much of a benefit of networking with PE firms directly. And so maybe the energy off, I would say, probably should be focused more towards making a good impression with headhunters and having a more general understanding of what kinds of firms you want to go to and why. And then, after making it past maybe the first round or so, or sorry, maybe after securing an interview or, making it past the first round, that's probably more of the time to sort of dig a little bit deeper by reaching out to professionals at PE firms specifically that you're interviewing with to sort of learn more about like the components that we discussed on page 9 uh, to help you make your informed decision should you be so lucky as to uh, progress in the process.
Mm-hmm. Totally agree. The one other advice I would give on interacting with the headhunters is be specific with them about what you want. If you tell them you want anything, they won't send you anything. You need to tell them, I want I want a private equity investment team opportunity with funds between 1 and 5 billion who have a generalist seat so I can work across industries, and I want to be plus or minus market compensation of 250 for a first year. Like that gives them something to work with. If you just say, "Yeah, I want to work in private equity," it's hard for them to find opportunities that they think you will take because they think you don't know what you want. And if you don't tell them what you want, it's really easy for them to think you just don't know.
Completely agree.
I think the left-hand side, knowing your deals, is incredibly important in talking with headhunters to a degree, but especially once you get to talking to the fund, knowing your deals is incredibly important. I talked about the deals I worked on in consulting for every single private equity interview I had. And then when I changed firms, I talked about the deals I had done in private equity at my first shop with every single firm I interviewed with. It is incredibly important. And you need to be able to speak to that deal as if it is so fresh. You went to IC yesterday and you know all of the details of the deal right off the top of your head. So I think knowing your deals is probably like one of the most important pieces of advice in this entire document. And then in terms of walk me through your deals, I think the biggest mistake most people make here is they ramble. The person interviewing you, they will definitely ask questions. Keep the walk me through your deals very punchy, 90 seconds or less, and then allow them to dictate the conversation because they'll have the things you're fishing for. If you ramble, you're probably not going to hit it. If you are short and sweet and then turn it into a conversation, generally a much better approach to walking me through your deals.
Yeah, I totally agree. And on the walking me through your deals, this is one I struggled with a lot because I was rambling and I didn't necessarily know what people wanted to hear. Uh, but with the help of mentors, I finally understood, how I should be going, how long a walkthrough should be, what I should hit on, what should I leave, for the imagination slash Q&A, and how to position an answer such that the questions that you want to answer come up so that you can hit the key points that you want to make without having to, put them all on the table immediately. But this is definitely not a simple one. It's an art, and I spent many. I would revise my walkthroughs many times until I felt like I got it perfectly, and that was a very long process. Yeah, so we go over some key interview questions. I think just summarizing, sorry, questions rather. I think just the summary of it is you want to make sure your answers actually make sense. You want to make sure your answers tie towards your broader narrative of what that you're trying to, pitch your counterparty at a private equity firm. So why you want to do private equity, why you want to join their firm, why you like their strategy, why you like, maybe their culture or something like that. You want to make sure that everything you say ties to that, and that they think you would be a good addition to your team. So, like, as is the example, on the left, as they're thinking about, this guy's going to come and he's going to work on the model for our, multi-hundred million, buyout. And the reason why he wants to join is because he's getting crushed in banking and just, wants to do anything else. And he heard the lifestyle at PE is better. um, that's not great. You don't you get kind of stressed out thinking about that guy running your model, right? But maybe if you're a business services focused, fund, and you're interviewing a candidate and he says he's been doing business services at his bank for the past couple of years, and he's worked on some sell sides for your firm, and he is only interviewing with a subset of private equity firms, all either in industrials or business services, and yada yada yada, and he likes your strategy, and he's worked with some of your portcos before, he's come across them, then you're a little bit more interested in them, and they want to learn, and they want to stay in private equity long term, and you have a career track role. It just makes the interviewers feel like there's more fit. It gives them more comfort that if they were to hand you off some sort of work, that you'll put your full attention into it, and that you're a safe pair of hands, if anything. That's kind of how I view this. Obviously, there's like technical questions as well, but the more behavioral kinds of questions, I think that is the framework by which I sort of generally think of answering these questions. But what about you, Austin?
Yeah, I agree, Brian, and I think research here is very important because unless you've actually worked opposite these funds, like the example you had with you're the sell side banker for an asset that they have sold or that you've sold to them, it's hard to know about their strategy and about the people and the types of businesses they buy. So doing your research up front helps you make the case and draw out the pieces of your background that are relevant for that specific fund. So I think it's research, research, research.
Yeah, yeah, definitely. Sometimes you bump into these guys who you say, "Oh, why would you like to join my firm?" And for many people, myself included, is I just want to break into private equity. That's why I'm here. But sometimes they go the opposite direction, and they'll say something like, "I've always wanted to join your firm. You guys, I love what you guys are doing." And then like, this is like my number one priority is to join you guys. And then you ask them a pretty basic question and name one portfolio company, and they can't name it. Then it's like, okay, maybe this isn't exactly like the best fit. And one strategy to kind of get around, a lot of private equity firms have very like opaque websites that don't tell you a whole ton. And
Hmm.
but then you're also trying to make it seem like you know a thing or two. Well, one strategy is to maybe have some of your friends who do work in like similar PE firms, if not that PE firm, and try to get a sense of like how to answer the question, or like what kind of like differentiation exists within business services, for example, and then you go from there, and ask your friends, like, is this a way that I can answer the question without seeming too corny, while also seemingly well read, but intellectually honest enough to know that I don't know everything because I haven't worked in private equity before. And that's a hard balance to strike, to my opinion. But I think it's this one tends to be more of like a strike, check the box, like, why do you want to join us? It's like, have you done like 5 minutes of maybe 20 minutes of research is what people I think are more so looking for, instead of like a highly curated, of your 10 portfolio companies, like, this is why I like each one of them, and blah 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 blah.
Yeah, yeah, that's a good point.
Yeah.
I think a good place to start your research is this slide right here. Let's say before you go talk to CPI, the one on the top left, you should
Mhm.
you should know these firms, right? Like a lot of these that are listed here are your bigger funds, and if you're keeping up on general private equity news, you should have heard of a number of these players by now. Axios Pro Rata is a great newsletter for general private equity news. And then if you somehow have access through school or through your bank for like Wall Street Journal Private Equity Pro, or if you're covering infrastructure, like an information, trying to keep up with these names is helpful. And when you go to the private equity recruiting process, you'll already be familiar with a lot of the names, and that will help start you down the path of understanding what actually makes them all different. So two things that I would add to this slide here is one, this is not an exhaustive list of these firms' coverage. So by talking to the headhunters and sharing with them what you want, it will help them better understand what they have that matches with your needs. So if you don't see one of the 20 names under CPI and you talk to CPI and you say, I want these three things, and then they pitch you a firm that you've never heard of, that's not the time to say no. That's the time for you to do your research and figure out, hmm, when I told the headhunter that I want these things, they told me this firm. Let me see if they're blowing smoke, or because they're just trying to fill a role that they're having trouble filling, or if this is actually a thoughtful recommendation based on what I want. So that would be my first ad here. The second is that a lot of these firms have different sub strategies. Staying on CPI, for example, um, if you go to Platinum Equity, right? Platinum Equity has their large cap kind of industrials buyout that they're historically known for. But as they've gotten bigger, they've actually launched a middle market and a lower middle market strategy. So if you talk to CPI and you only think about Platinum Equity as large cap buyout with a history of buying distressed assets, you might miss the opportunity to think about or ask about, well, actually, I'm looking for middle market offering. I'm looking for a middle market role or a lower middle market role, and they actually have strategies that match for me there. So within each of these names, there's often multiple strategies or products. And so even though when you first think about a firm or you read about them in the news, it might not seem like what you want to do, or it might seem like that is what you want to do, know that there are different buckets. And the same thing goes in reverse, right? Like if they're pitching you Platinum Equity and you want to work for large cap buyouts and they kind of do the bait and switch and you're interviewing for their lower middle market buyout, you're like, oh, well, that's not what I signed up for. So make sure you're careful in when they're pitching you a firm, asking about what group within and what strategy to make sure you're actually interviewing with and getting the group that you think you're getting.
Totally agree, and I think sometimes even um, like these headhunters collect. Well, I'm pretty sure they do. They collect data points on you, and they kind of assess how you react to different opportunities. And the more you sort of accept these random ones that don't actually align with what you stated you're looking for, I think the more of those kinds of opportunities you'll get.
Mhm.
Um, so if you say I only want to do industrials and business services and maybe a tiny bit of, or maybe if you said that's just what you want to do, and then someone randomly pitches you a deal that like a fund that does consumer because no one seems to want to apply for that role, and then oh, okay, I'll take a look at that, and then it's a bit of a slippery slope, where you probably won't be top of mind the next time an industrials or business services fund opportunity comes around, because they'll give it they'll show that to the guy who is pretty strict in his acceptance of different types of opportunities, because that person probably is a little more interested and a little bit more focused, a little bit more locked in. And so I always, if I got like a random kind of role and I could not really understand the merit of it, and then the narrative that the headhunter gave to me about why it fits what I'm looking for didn't make a lot of sense, I would usually politely decline, even if I'm just trying to break into private equity.
Yeah, totally agree.
Um, just an overview of the interview process. I think just the key points are, of course, you'll get your background stuff questions, right? Why do you want to join our firm? Why do you want to work in private equity? What kind of strategies what kind of other strategies are you interviewing with? And, hopefully you'll try to keep it tight, right? Not so tight, like I only want to join your firm, but not so broad as, I'll join any firm in private equity, somewhere in the middle. probably leaning more towards, a tighter story is probably the right place you want to be at. You get some technical questions like you did in banking. I think they tend to be less, you know, memorize these, 100 questions and you'll be good. A lot of them are more, a lot of them are more, I'm not sure what the word is, a little bit more intellectual, if you will, and a little bit more open-ended and more focused on how you think rather than your ability to do like mental math or understand accounting statements because you've already done banking and so you should understand those. They're more of questions to sort of suss out your quote unquote investor mindset. So maybe you've discussed like a pretend company that someone made up, and you just walk through a mini case study, if you will, and your ability to sort of think critically here will is what helps you stand out. Those who are not as well trained to think critically might not do so well because they haven't memorized the answer to these kinds of questions. But the more you can think quickly and critically, the more you'll show that you can kind of like constructively work together to sort of arrive at the quote unquote like correct or right response or at least way of thinking. Of course, know your deals, and then from knowledge, you should at least have read the website and a pretty kind of 80/20 understanding of what they're doing, recent exits, what their core strategy is and stuff like that. And then, as we touch on as Austin and I touch on in another YouTube video, which you should totally check out, is you get a case study. Well, there's also a modeling test, case study and modeling test, sometimes at the same time and sometimes differently. We have a modeling test YouTube video as well. You should totally check that one out as well. This is a whole can of worms, but you know, instead of asking you questions to sort of gauge how well you might do at the job, most private equity firms just give you a case study and say a case study typically of which includes like you getting a sim or an investment sim or an IM, and then you getting a certain amount of time, maybe a couple of hours or a weekend or a week to put together an investment committee memo and a model. And that is basically what you do as an associate. So it's a good way for PE firms to assess, where you are with your whole like, investor mindset and your, technical skills and your modeling skills and all that stuff. And then at the end, you have the conversation with the partner, and that one's show him you're a hardworking guy who's fun to talk to. I'm sure other stuff matters as well, but that's what I think that partner interview typically is kind of more about. It's can they think you're a hardworking nice guy. That's I think the key points. And then there's like on cycle and off cycle. On cycle is all these things happen in a short period of time. Um, it's a bit more chaotic. Off, usually kicking off when you just started your job or maybe even before. Off cycle, which is what Austin and I did, is maybe you've worked for a year or 2 years or so, and then you're going through like a slower process on an as needed basis for the PE fund. And then those at that point they typically focus a little bit more on your investor mindset and your case study because you've already worked for a year or two and you're starting in, a shorter period of time, maybe like in a few months. So your ability to sort of do that case study or that investment memo or that model in the near term is a little bit more important, perhaps, than, and your ability to demonstrate an investor mindset is probably a little bit more important than a candidate who is, maybe has not even started the job yet. They're in training or something because they'll have 2 years to develop, those skill sets. And so, on cycle, I feel like it's based more on like potential, and off cycle is more based on like ability to execute in the near term. But that's a more nuanced topic. So Austin, do let us know if you have anything to add there since we both did off cycle.
I love your shameless plug for our other videos.
Yeah.
Um, so I agree. The case study, and we say this in the video, is really your opportunity to differentiate. There are plenty of people who can tell you how $10 of depreciation flows through the financial statements and can walk me through what is an LBO. But the case study is really your opportunity to differentiate. And so again, I'll also plug the video. It's a great way to get a little introduction to how Brian and I would recommend we do it. Might be the right way, might be the wrong way, but it's at least our take on it. And then we'll finish up last slide here. I know we've run pretty long, but there's a list of common behavioral and fit questions. These are ones to have in mind, think about I think the most important ones are the first two. Why are you interested in private equity and why our firm? If you I always wrote these down. I thought about it beforehand. I wrote my answers, then I prioritized my 3 to 4 reasons why, and I would always have those jotted in my notebook when I went to interview at the firms. A lot of the other ones, I think you can at least how I approached the behavioral questions is I would typically do a story bank where I would have a set of, you know, 10 to 15 stories that I thought were compelling stories that showed, demonstrated, not told, but demonstrated a specific set of traits that I thought people might ask about. And then I would just use the stories from the story bank as needed to fit the types of questions, the types of behavioral questions that folks would ask. Brian, anything you would add here on behavioral and fit questions? Otherwise, I'm happy to wrap it up for us.
Just I think it's a pretty good point, right? There's like so many questions on this list, but the first two are the ones that you probably will get asked, right? At least by the headhunter, number one, why you
Hmm.
want to do private equity, and then by the most PE funds, probably the second one as well. But then the rest is there's an endless list of questions that you could be asked, and instead of spending so much time to think about what your girlfriend will describe you as in 3 words or something.
Hmm.
Maybe like I think I mean I didn't do this, but I thought what I just sort of said. Well, I hope I can come up with a good response if someone asks me that question. I think what Austin said about the bank of stories is great because you just have a couple stories in your mind and then whatever the question is, you can sort of 80/20 at the very least tailor it towards demonstrating the characteristic that the underlying characteristic that the PE firm is trying to suss out whether you have. So I think that's probably the best way to do it and focus more of your time on the first two ones.
Yeah, that's great. Well, in closing, we appreciate you spending an hour and a half with us today as we walk through the introduction to private equity recruiting. You know, for Brian and I, it's been a great career transition and a really rewarding career up to this point. However, it's a challenging and it's an opaque process to navigate. So we're hoping that the two of our experiences can help shed some light on this process and help make it a little more approachable and inclusive for those of you who also think this would be a great line of work for you. And with that, thank you very much for your time and keep checking out the Proforma Futures website for more learning material, as well as the YouTube channel for other related videos to private equity recruiting.
Thanks very much.